All right. Hello, everybody, and welcome to today's webinar. I am Jaclyn Kelley. I'm the broker owner at Better Homes and Gardens Real Estate Destinations in the Florida Keys and in South Florida, and also Star Properties Destinations, where we it's a property management company. We specialize in managing vacation rentals, long-term rentals, commercial properties, and all of that good stuff. So today our webinar is focusing on investing in real estate. So this is a really fun topic, and we are delighted to get this underway. I'm going to give a quick introduction to our panelist members, and then throughout the webinar today, we're going to switch back and forth and have each of our panelists talk. And at the end, we're going to answer any questions that you might have. So feel free to put them into the chat, and we'll be sure to answer those to the best that we can. And if we run out of time, your dedicated agent will reach out to you after this webinar to make sure that your questions are answered. We really look forward to those questions. So be sure to ask away, and we will get to those. All right. So today on our panel, we have Karen Williams-deCastro. She's an agent here at Better Homes and Gardens. Erin Kiel, an agent here at Better Homes and Gardens. And they're also investors themselves. They are not only skilled in helping you purchase or sell investment properties, but they're also investors as well. So they are excellent industry experts today in investing. And we have Lynette Remund from Tewes Mortgage. So she'll be here to talk to you guys all about financing your investment property. Super important piece of that puzzle. And just a quick little introduction to a couple of committee members who are behind the scenes who really helped put this together. Jana Pratt, she is here on the call today. We also had Samantha Arce. We have Rodriguez, Stephanie Camacho. I think that was everybody. Everybody was so busy with all of this. And of course, this is part of a 5-part webinar series to help you learn all about home buying and the process. And there's a lot to it. So this is number 3 in our series. Keep in mind, we are located in South Florida. Most of this information is going to be valid to you no matter where you are. So if you are located somewhere else in the country or even the world, there might be some slight differences for your part of the country, but most of this information is pretty valid. If you have specific questions, again, please ask in the chat or ask us. Even after this, we are really happy to help you figure out the best solution from where you might be located. Insurance, of course, is always different for us here in South Florida. We have all the insurances. We need them all. So you might not where you're located, which could certainly change your cap rate if you're an investor. So yes, there'll be some differences there. So without further ado, today we're going to talk about investing in the different types of rental properties. Of course, there's long-term, which a lot of people seem to forget about these days with Airbnb taken off and the short-term rental market. There's such a big difference in management and in income and in expenses. So we'll talk about those differences a little bit and financing those investments and all of that. So we're going to go ahead and let Karen take it away. She's going to let me go ahead and pass the mic over to you, Karen. There you go. And
thank you.
You're welcome. Please, really excited to hear what you have to say about investing. You've been an agent for a long time here. You have worked with a number of investors on the buying side and the selling side. So I'd really love to hear your experience in that. And of course, you are an investor yourself. So please share with us your experiences.
Absolutely. So just real quick, my name is Karen. I'm a realtor here in the Florida Keys. I've been a realtor since 2015. And one of the things I learned when I decided I was going to become a realtor was how important real estate was to generational wealth. And so that's kind of what I'm going to talk about today. LendingTree did a survey and I had to look it up. And when they asked people, what are the best ways to build wealth, 45% of people said real estate. And that was followed by the stock market at 32%, saving bonds at 21%, cash at 21%, and tax advantage retirement accounts at 16%. So if real estate is the number one way of building wealth, and that's what you want to do, then you're in the right spot. So when you rent a house, you are literally building someone else's portfolio. You're helping build their wealth. So one of the best ways to get into building generational wealth while investing in real estate is by buying your own home. Of course, this becomes an asset that you can pass down from generation to generation. But when you own your own home and pay it off, again, I should mention this too. I mentioned before that real estate tends to be the largest asset that anyone ever owns, right? And so, of course, you'll make sure that you have the proper people in place. You'll have the right real estate agent. You'll have the proper lenders in place. But it is typically the largest asset that the average person will ever own. Over time, that asset builds up equity, right? So as you pay down your mortgage and your home value appreciates, then you get equity in the house. Now, this equity can be invaluable when you pass it down to your heirs. There's tax benefits as well, but you will want to talk to your CPA about those. They will be able to make recommendations based on your particular situation. And then with your heirs, one of the good things about this is, as you can see, the housing market is continuously increasing. It's consistently costing more to get into homes. So when you pass down this house to your children or your grandchildren or whoever you want to pass it down to, you are in essence giving them a very valuable asset that they can live in, they can rent out, they can sell. There are so many options to that. And so when you are looking to buy your home, if that's something that you're interested in, is having an asset that will be passed down from generation to generation, make sure your realtor knows that, because in our market, there may be other ways that your realtor may be able to help you. This may be a property that you don't plan on living in right away. If that's the case, your realtor may suggest that you get a mobile home, right? Because of all the things that are forthcoming, eventually that mobile home property will likely be worth a lot of money, right? Because it has a structure on it. So by making sure that your agent knows exactly what your plans are, and they will get into that when they do your buyer's consultation. I cannot stress how important the buyer's consultation is. Any agent that's worth their salt is going to do a buyer's consultation with you, and make sure that you're just open and honest with them so that they can help you. Another way that you can build generational wealth is with long-term rentals. I'm not going to talk about short-term rentals. That's really not my area of expertise, if you will. But I do long-term rentals. And the good thing about that is the amount of income that you can produce. Now, when you get a rental property, a lot of times in our market, the goal pretty much is to break even. A lot of times there are instances where you can find properties where you can create a little bit of profit. But don't forget that even if you're breaking even on that asset, you're still gaining the equity. And so if it's a short-term rental, you still get to have enjoyment of the property and still get that equity. And if it's a long-term rental, you still get the equity. It's a win-win. You really can't go wrong. So the question that I would make sure that I would ask before you got into any type of investment opportunity for rentals is, will the rental income that I generate cover the expenses, right? And sometimes, again, just breaking even, if it's the right type of property, which your agent can help you with, that may just be the goal. Now, if you're trying to flip property, that's different. I'm not really talking about flippers at this point. I'm really talking about just people who want to purchase the property and hold on to that asset to allow it to grow in value. Now, there's multiple ways that you can purchase investment property, and this is where your lender comes in. It is so important that you have a really good lender when you're going through this process. when you're getting a property that is for investment, there's so many different pieces that are moving. You don't want to have to worry about how much money do I need down, da, 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 da. You really need to be able to talk to a lender that knows about investments. We have one on our webinar today. And that's going to be important. But I'm going to let the lender talk about that. What I'm going to talk to you about is seller financing. My husband and I bought a multi-unit, and we did that through seller financing. And what seller financing is the person who is selling the house, they basically become the bank. They hold the paper they hold the mortgage. And so you pay them every month or whatever terms you guys determine. And that allows you to get into the property. There's lots of pros on both sides. So with seller financing, in our case, I'll use our case as an example of where you can kind of think outside of the box. Maybe there's a property that you want or that someone wants to sell, but they really want to continue to get that monthly income. If they're seller financing it, they will still get monthly income because you will be paying them just like you would pay the bank. And the benefit to the buyer is that you may be able to negotiate a better interest rate, right? Right now, interest rates are wherever they are. I know better than to say what interest rates are, but wherever they are, you may be able to negotiate a better rate with the seller of the property. And so there can be lots of benefits for both parties with seller financing. And it also makes it possible for people who may not be able to get financing through a lender. Seller financing could make that possible. So your local real estate agent is going to be the perfect resource for when you're looking to get rentals, investment property. And the reason why is because your agent that's local to the market, they know what the market rates are for the type of property that you want. If they have a really good property management team, then they also can tell you what the occupancy rates are for short-term rentals. They can tell you about how much you could make for the year. They can do all of that stuff. So making sure you have the proper realtor and the proper lender is going to be key. Now, I said a little bit about short-term rentals, and that your agent would know what the occupancy rate is. Here at Better Homes and Gardens, we have a property management team, and they're really good about giving you quotes and things like that so that you can determine if this is the right property for you. But I'm not going to talk about short-term rentals. For success in short-term rentals, we're going to let Jaclyn talk about that. And she's going to discuss how property management can make such a huge difference for you, whether it's on a short-term property or a long-term rental property. And so, Jaclyn, I'm going to pass the microphone right back to you.
Great, Karen, thank you so much. You made a lot of good points there. And there's a lot of differences, huge differences really in owning a short-term rental property versus a long-term rental property. So I'll touch on just a couple of those differences. As Karen said, we do a lot of property management here in office, and believe it or not, actually at the end of the month, a lot of our owners will net the same amount, whether they're long-term or short-term. And the net is the amount that's being paid to the owner. Even though the vacation rentals actually will the gross amount, the total amount that we bring in is typically a lot higher. The payout to the owner a lot of times is actually the same or pretty similar. And the reason being is because there's more expenses that go into the vacation rental typically. For one, the management fee is typically higher. There's a lot more work that goes into a short-term rental. And for you, if you're considering a short-term rental, doing it yourself, you absolutely can, depending on your situation. But the inquiries come in 24 hours a day. We have a centralized website that pushes the properties out to all of the major channels, Vrbo and Airbnb, Google Vacation Rentals, and all of those. So we have inquiries coming in from all these different channels all throughout the day and the night. So it's a lot of work there. So once we're answering questions all of the time, and then booking it and taking the money, holding it in escrow, Then we start to ask the customer questions, how we can help make their vacation better. So it's really a vacation rental company. It's a vacation company. So there's a lot that goes into it. We do pre-occupancy checks before they get here. So there's so much that goes into it. So the management fees are typically a little bit higher. But also there's more wear and tear on the unit, and you have to provide all the essentials and necessities that you would want on vacation. So really nice linens. We have to replace the pillows every year or two. Make sure the mattresses are comfortable, and really make it a destination. And that's where our namesake comes in. We specialize in making sure that our vacation rentals are really a destination for the client. So that's my advice to you. If you were thinking about a vacation rental and doing it yourself, make sure you really make it feel like a resort or a hotel. The difference in there's a real difference too in the demand. Demand has really picked up on short-term rentals in the past 10 or 15 years, where it's become so popular by these other channels, Airbnb and Vrbo. So there's a lot more competition. So there's some hosts out there that are getting really creative and offering, kayaks and paddle boards and photo ops at their house and so many different things. There's so many things you can do to really make yours stand out. So make sure you're making it stand out, and you have all the luxury items that you would want at a resort, and also convenience items that will help you attract different travelers. So pack and play and a high chair for those with kids. Some games, some yard games are fun, like a dartboard or a pool table or a foosball and things like that, so people can have fun, especially if they're staying at a 28-day minimum stay property like here in Monroe County that we have. And I'll circle back to that in a few minutes, but the longer the stay, the more that they're going to require. But also having a workstation is really trending right now. So that will attract all the remote workers who can stay for a month or 6 months, and they can work remotely. So having a nice, comfortable desk is really important. So you got to really wrap your head around it. If you're doing vacation rentals, it's a whole nother type. It's a traveler. And they want to feel comfortable and like they're staying at home, but also at a resort. And so you really get to appeal to them on multiple levels. The long-term tenant is a little bit different. Typically in the contract, there might even be a stipulation that they are required to repair anything small, like anything up to say $250 or $500. So the tenant is more hands-on and taking care of the property a little bit differently because they're living there long-term. There's also a difference between vacancies. So the long-term tenant is there for typically a year or multiple years. So you might rent for a smaller amount every month, but it's rented every month. So it really is going to depend on why you're investing. So here in the Florida Keys, we have a lot of second homeowners that like to come down and utilize the property. So for them, a vacation rental is a great idea because they can still utilize it themselves. So there's really no true one answer on which is the right investment property. It's really, or the right type. It's going to depend on your needs and your desires and desire to rent, use the property and a number of different things, and how hands-on you like to be. And if you are uncomfortable with people staying in your property and moving furniture around and, damaging towels here and there, that type of stuff happens. So, but having a good property management really can make all the difference. And as I said, we do pre-occupancy checks before each tenant. So we like to look at the property, make sure everything is where it should be, that nothing got lost or damaged or any of that. But also a good property management company is going to help you protect your asset. So in ways that you might not even think about. For example, we do life and safety inspections as well. And for the short-term rentals, we help with all the proper documentation and paperwork for our county or with the city to make sure that you're properly licensed, get that life and fire safety inspection, but also doing things like risk assessment. We walk through the property and make sure that there's anything reducing liability. For example, making sure there's proper handrails on the property. We had to get some installed recently at a property she had been renting on her own on the second floor, and there were no handrails. People could easily fall over that balcony, and she didn't really even think about it that way because it's been that way forever. Moving the barbecue grill away from the house and anything that could be flammable. So we kind of look at it in a little bit of a different light and helping to, we've seen a lot. When you're in property management for a few years, you kind of see it all. So having a local property manager and also being available to answer any calls or concerns or things do go wrong in a vacation rental stay or even a long-term stay. So we can really help with all those things. So those are kind of the different types of property management, but I wanted to talk a little bit about some of the basic ins and outs of investing. I am frequently asked if this is the right time to invest. And what I always say is that you really have to buy when you are able and when you are ready. If you have the means to purchase right now, think about the future. Buy it now. And my favorite saying is, don't wait to buy real estate. Wait, I can mess it up now. Don't wait to buy real estate. You buy real estate and wait, because as rent continues to go up, you might not make a huge profit right now when you buy, but you will down the road. So even for those long-term tenants, rent all over the world continues to go up and your mortgage is going to stay the same. Your insurance might increase a little bit, some other expenses, but if you hang on to that property, real estate is a long-term investment. Sometimes you make money right away, but you always do in the future and over time. It's not meant to be a liquid investment that you're going to cash flow on all the time, but in that equity, as Karen touched on, the equity over time that you're gonna build is it's incredible to watch. I've watched my investment properties gain equity, and the rents have increased, so now they become more profitable each month. So that's really what you have to look at and think about where the property might be valued in a couple of years. So it might be a big nut to crack right now, but in a couple of years, it's not going to feel that way as property values continue to go up and yours, you're locked in to that purchase price. It's just been incredible to watch the values here in South Florida over the years. So that's my advice. Don't wait to buy real estate and wait. And lastly, a lot of people ask me about the return on investment. So if you're trying to calculate, is this a good investment or not? It's helpful to look at, so if you take your purchase price, let's use an example of 500,000. 500,000 actually is not your investment. Your investment is your acquisition cost, which would be your down payment and your closing costs. So if you have a $500,000 purchase price, let's say you put down 10%, and Lynette will get to that in a little bit on if that's going to be feasible or not. But as a good example, 10% down, because it's easy for me to calculate, that's $50,000. So $50,000 is actually your investment. Maybe we could put another 10 on there for closing costs. So $60,000 is actually your investment. So if you're comparing buying real estate to other investments, you need to look at the cash you're putting up. If I'm going to take $60,000 in investment, how much am I going to get on the real estate that I buy or on the stocks that I put it in or any other investment that you're considering? You need to look at the actual acquisition cost, not the purchase price. The purchase price is, assuming that you're getting a mortgage anyway, that's going to be your carrying. That's your expenses every month, and that's your debt service, and that's different. So let's take that. We have $50,000 or $60,000 down, and regular, that's probably going to get you a 2 or maybe a small 3-bedroom home here in the area right now, and you'll probably rent that for about $3,200 a month, let's say, for an example, and your mortgage is going to be $2,600 a month. So you might make $600 a month off of that right now. That doesn't sound like a whole lot, and you might actually spend some of that in your property management company or on repairs. But over time, next year, if the rent goes up to $3,300, now you're looking at $700 a month. And so, I mean, even if you rent it for the 2,600 and break even, like Karen mentioned, you know, that's usually our goal. If you can break even on your investment each month on those, if your expenses are covered each month, you're doing great. And over time, that rent's going to increase, and your equity is where you're going to be able to cash out on and even leverage that to purchase other vacation rental or other rental properties or other investments that you want to do. So think about it like that when you're looking at this and analyzing the different properties. Your local real estate agent should really be able to help you analyze the rental income or the projections of that, or your local property manager. So, so yeah, that's my advice is, make sure you're doing a thorough analysis of it and just pay attention to that money out of pocket, and you're gonna feel a lot different about it when you look at it like that. So, so I want to pass it over to Erin Kiel next. She is, as I mentioned, a great investor herself. She's done long-term and short-term. She can talk about some of the pitfalls in that, but I will turn it on, over to you, Erin. Take it away.
Thank you, Jaclyn. So yeah, my name is Erin Kiel. You guys hear me okay? Okay, cool. And I've been working and living in Florida Keys, in real estate since 2019, but I bought my first property when I was 22 years old. And I think one of the myths for investors is that you have to have all this money, you have to come from wealth, or you have to have like the highest paying job. And I definitely didn't have any of those things. I was lucky that I had a 2-income household, and I just made smart decisions and saved money. But and I'm so excited to talk to Lynette here in a few minutes, but I utilized my primary home. And so I'm going to talk about house hacking and then a little bit into 1031 exchanges, for how I've kind of built my small portfolio, but just had some experience in different scenarios, and I've made money and I've lost money. And like Jaclyn said, and Karen said, for investments, I definitely believe in diversification. Real estate's my favorite investment. I enjoy it the most, but you know, I believe in diversification. So it's the Roth, the IRAs, the, you know, money markets, all that kind of stuff. But for my future goals, if you really want to invest in real estate, I think it's important to know what you want out of it. I know I want some freedom and I want to maybe retire a little bit earlier, but I know that I always want to own my real estate. And so I'm looking from an appreciation standpoint, like Jaclyn was talking about. I'm not necessarily, I love money. Like I want it to cash flow, but I'll be okay if it doesn't do a crazy amount of cash flow every month. I want to buy and wait. So anyway, so I utilized my primary residence. I had an FHA loan. I lived in it for 5 years, and then life happened, and work took us away to different cities and states. And so we decided to buy another house, but hold on to our primary residence. And that really catapulted us to be able to continue to buy a property. I apologize. My alarm's going off. One second. Alexa, dismiss alarm. Sorry about that. Got some cooking going on here today too. So that catapulted us to be able to buy more property. And the second property, we again used a primary loan. And from there, and so we were able to put less money down for these properties. And there's different stipulations. You have to own property for a certain amount of time before you can, you know, maybe change it into a rental property. But that's essentially what we did as we moved around the country, is held property, turned them into long-term rentals, and used, you know, our money for the down payments for the new houses. And you might think, I don't have enough money to be able to hold on to my house and buy another house. Like I definitely need to sell. But when you talk to somebody like Lynette, you know, they're the ones that are going to be able to tell you what your actual buying power is. And I feel like most of our clients, if you guys agree, would be surprised. You know, they think that they can afford X, Y, and Z both ways. But they're really surprised until they talk to an actual loan officer what they can actually afford. And so So yeah, that's how I started. I also had peppered in a little bit of house hacking. It's something I do to this day. And again, maybe something people are like, I can't do that. It's a very a buzzy word, a trendy word the last, I think, 5 years, but it's essentially you have a roommate. And you'll also have to determine in your county and your municipalities what's legal, because house hacking could also be something like you rent out a room for an Airbnb situation. Doesn't necessarily have to be a long-term roommate. But again, you just have to check with your county to make sure what's legal for your area. But that's what I did. I've had roommates. When I look at houses as investments, I always think, how can this house be shared where I don't have to see my roommate? So if you're somewhere that has basements, I love looking for walkout basements. I can put a wall or put a door up. If you have kids, I think I was starting to talk about this. It doesn't mean that you can't do these things too. You can get creative, and it does take sacrifice. And so, but we were just willing to do that. We were willing to save money. We're willing to sacrifice our space in order to get more properties. So that's just a little bit about house hacking. Again, with house hacking properties, we were able to use more conventional financing. And then, so we've had long-term rentals, and then we switched over and we really wanted a short-term rental property in a destination location in Florida. And so what we did was we utilized a tool called 1031 exchange. And we took one of our long-term rental properties. You can exchange an investment property for a like property of equal or greater value is the goal. And it's really just so that you can not pay your capital gains tax on that property. You'll pay it eventually if you ever sell the property you're going to exchange, but you don't have to at that moment. So we had a property that really appreciated well. If we sold it on its own, we would have paid a lot in taxes. And so we decided to do the 1031 exchange and buy another property that we really wanted. So there is a third party to this transaction. It's called an intermediary, and it's you do have to pay them. So there's a fee, usually around a couple thousand, maybe less. And when you sell your property, the profit of that property gets held in an escrow account by the intermediary. And you can't have that profit hit your bank account, because then the IRS wants their money. So the intermediary holds that money. And then there's stipulations, like you have a certain number of days to identify property and to close on your future property you're going to purchase, which your intermediary can help you with. But they hold that money until you're ready to make an offer. And then they use that money in the escrow for your escrow, and then for your down payment. And like I said, the goal is to use all of that money so that you don't have to pay taxes. But that's okay. If there's a little bit left over, you just have to pay taxes on what you don't use. That's called boot. But yeah, so that's how we got our short-term rental. Like Jaclyn said, there's a lot of components to it. I personally am more comfortable with long-term rentals. I really believe in that strategy. But the short-term rental, it was more of a personal, we wanted to try that out, and we like the location. So we'll see how it goes. But in addition to the 1031 exchange, we had to get some creative financing. We do have multiple properties, so our debt has increased. Even though we do show income, we pay our taxes on our rentals, we couldn't get conventional financing. And so that's where Lynette, I'm going to introduce Lynette Remund to you guys. I don't know if Lynette is, yep, I see her screen phone. Hi, Lynette. Hi. So that's where obviously a local realtor to the area to help you build your team when you have investment properties, from property managers, handymen, electricians, etc. Those are all important pieces, and a realtor can help you. But the other extremely important piece is your loan officer, and they are like your best friend during this process. And like what Karen said, you have to be transparent with your goals with your realtor and your loan officer. They're going to know. Like if you're trying to hide debt or whatever, they're going to find it with your goals. So for me, it's, I want to hold, I want to buy and hold. I'm trying to figure out how I can come up with this down payment. Maybe this particular house just doesn't fit this type of loan product. So what else do you have for me? So with that 1031 exchange, I actually did a DSCR loan. I know Lynette's probably going to cover that, but I'm going to introduce Lynette. Sorry, I got kind of off on a tangent. She's a local loan officer. She works with Tewes Mortgage in Marathon and services the Florida Keys and has her license in Florida. I'd like you to introduce yourself a little bit more, Lynette, and then also, can you tell us if you service anywhere outside of Florida?
Sure. Well, thank you all very much for having me on your weekly webinar. I think this is a fabulous tool that you are offering all of your clients and anybody out there that is looking. Investments, yes, it's not just a cookie cutter situation. Jaclyn, Karen, and Erin, you all brought excellent ideas, details, specifics of every aspect of investments. My background, I will tell you, I have a tremendous background in investments myself. I own a property management company, as well as I have owned a construction company. I have sold real estate, and I am now a mortgage broker. Loan originator is my official Florida state title. So I originate loans within the entire state of Florida. I am not licensed and I cannot do loans outside of the state of Florida when it is conventional FHA. I can do in some states some DSCR loans. So depending on the specifics in what state the property is being purchased, where the owners live, the buyers, there's many details there. But over 25 years working with investors, and I have learned a tremendous amount of knowledge in watching them purchase their properties and assisting them in purchasing their properties and all of the different pieces that go into this. Talking to and developing a relationship with a loan officer is extremely important. You guys have all touched on this, where this is a relationship, and all of us together, we really are a team. And I would be working not only with the buyers, but with the realtors and working together. I have several investors that I just know their portfolio. I know what's out there. I know what products are being released. I know what their goals are. And we just communicate every few months, sometimes more, sometimes less, but we communicate. We talk about reaching their goals and what they're looking for. And we've had situations where investors have said, I need to do ABC, and we know what it's going to take to get there. And we wait for the market to bring us to that position. And then it's like starting the race. The gates are open and everybody starts running to, okay, go, go, go. Stars are aligned, dots are hitting, let's make this happen. And so to have that team together, the realtor, the financing, the buyer, savings, which type of loan, knowing all of those things in their buying power, it just sets them up for success. So a little background on me, how I have all of this vast knowledge. I've owned investment properties. I've flipped investment properties. I've managed investment properties. I have financed investment properties. So that's a little bit about me.
That's awesome. You're very well versed in this industry. So exciting. And like you said, it's literally, I mean, we're all a team. We all need to communicate and be transparent. And so let's get to the nitty-gritty of some products that are not, well, I mean, we could touch a little bit on the conventional, 20% down. That is an option, right, for investors?
Yeah, conventional is absolutely an option. Conventional is just a type of loan, just like the DSCR, just like a hard money loan or a private money loan or a home equity. It's a type of loan. And as you had mentioned, Erin, when you had done some financing, and I think Karen, you'd mentioned seller financing as well. There's all these different, there's hundreds of different loans out there. And so my job as your loan originator is to get all of that information and to figure out which loan you fit best within. So conventional, yeah. When you're looking at a conventional, they do like to see on an investment property more 25 to 30% down. We have seen some at 20%, but you're looking at more of a seasoned investor. A lot of reserves in their finances, cash in the bank, cash in hand, lots of cash flow. It's a puzzle. And we're putting all of the pieces, and it's a proper allocation of money. So someone with 20% down or 30% down, maybe their debt to income can be tighter if they have more down. So we move the money around where it will flow best for the investor.
Right.
There are different types of investors. There's the first-time investor. There's an investor that has already been investing and has properties and adding to their portfolio. And then you have the fix and flip, which doesn't sound like we're going to talk today about the fix and flip. So let's just focus on first-time investors and then existing investors. And a first-time investor, it is a little more difficult to get into the market to be an investor. That is true, but just like you had mentioned, Erin, the proper direction when you are trying to become an investor is using that equity in your primary home. And so we can assist you in pulling up that equity, depending on whether you do a home equity line of credit, a home equity loan, or you just do a cash out refinance on your home. So multiple different directions that we can do to tap into the equity that you have in your home. Most of the banks and the brokers and the lenders, they want to see this no more than a loan to value of 95%, 90%, 95% in there. So you can't take out all of your equity. If you purchased your home for $500,000 and now it's worth $600,000, you could probably tap into about $90,000 there and walk away with that. So there's a different amount, but we can sit down, we can determine how much equity you have in your home, run some calculations, and go that direction. So those different types of finances, when we're talking about the first-time investor, not a lot of the non-qualifying, the conventional is more of the direction you're going to go. The DSCR loans and renovation loans, they're going to want to see somebody with a history of having some investment properties. So first-time investors coming in, you have your primary home, you've got some equity, we're going to be looking at more of some conventional financing from you. But you can take that equity from over here, and if we can make sure that the rents with that down payment, that equity transition over, if everything, as you were mentioning previously, if it pays for itself, or maybe you get a couple $100 extra a month, we can show that. And so that assists with purchasing those. And then when you have an investor that's seasoned and has multiple properties, that's where creative financing comes in, because as you mentioned, there's a lot going out, but there's also a lot going in. And if your loan originator doesn't present your file appropriately to the lenders, they're going to decline it, or underwriting's going to ask a ton of questions. It could delay closing, it could cause issues, or they could just not fund the loan. So it's extremely important. We're going to find out. Be very clear with us when you're talking to us. Anything that you think is going to come up, any debt you have, things on your credit, we're going to want to do soft pulls on credit and review everything before we submit it for actual funding. It's nice when you are starting to look to add to your portfolio or start a portfolio to have that conversation, so we can determine that that buying power that you have.
Mhm.
When you're a seasoned investor, you can get the DSCR loans. Those are loans that are based more off of reserves. How much money do you have in your liquid money? Not I have stocks and I have to sell them, or I have a 401k. We can use a percentage of that money, but you can't use all of it. They want to see the cash you have in the bank. So we're going to take a look at that, which is going to be determining how many months of reserves you have to cover all of your expenses. And when we take a look at that, then we can calculate out some buying power, how much down. Again, we're going to want to see 20 to 30%, whether you pull that from equity from another investment property, have it cash in hand, or pulling from your private primary, any direction there. So, yeah.
And can you verify for the DSCR, the debt service coverage ratio loan? So if somebody doesn't show like W-2s, and they're having a problem with that, but for that loan, it takes into account how much rental the property can make, right?
Correct. So if we're able to show that the purchase price and the mortgage payment that you will have with that purchase price can be covered with rents. Now, if it's a new property, it's not in your portfolio currently, and this is a new purchase, we can only utilize 75% of the rental income. If it's established and it's on your tax returns and you're trying to pull equity out of an investment for another investment, we can use 100% of what is on your tax return. So again, the conversation and really opening up all the books to show everything. You could have just increased your rent and now you have an additional $500 a month of cash flow and you think, oh, this is great. But the lenders are going off the tax returns. So great, you have $500 more. Keep pocketing that, save that up. When we get that on next year's tax returns, then we can actually utilize those funds.
Gotcha.
W-2s, not necessarily anything. We do bank statement loans too. So a lot of self-employed individuals, a lot of money is going through their accounts, but any business owner, you're writing off everything you possibly can. You're not trying to pay the taxes. So a lot of lenders understand that. And they're looking at 2, 4, 6 months of bank statements and seeing the actual cash flow that you have and making decisions based off of the cash flow as well.
Gotcha. And is that similar for the bank statement loans? Is that going to be similar whether you're buying investment property or trying to get into a primary? If you don't have a W-2?
Yes.
Kind of a similar product.
Yes. Similar product, even if you're looking at getting into a primary. Correct.
Gotcha. Okay. So yeah, so for normal people, and we talked a little bit about, lending and finance in our last webinar, but more geared towards primary residents. And as this one's geared towards investors, for normal people, they can have either W-2s if they want to kind of go the conventional route, or show money if they're self-employed and bank statements. And one thing I don't think we've touched on a lot, or maybe Jaclyn did, but I would strongly recommend to show the money that you're bringing in and work with a CPA. And right off the bat, again, that's an important part of your team, and being straightforward with them and like telling them what you want to do, what your goal is, and they'll be able to help you with the write-offs and making sure that you show the money that you're making. I know some people might stray away from that, but it's really important if you want to build your portfolio so you could show that to somebody like Lynette, who's going to help you get the proper loan. So any other like crazy things that you've seen, or a certain situation that you were able to get somebody into an investment property? I know down here in the Keys too, we have a lot of condo tels, and you have to get creative with those. But anything in general that you'd want to add?
Well, it's always a little creative.
Yeah.
It's always very unique and it's interesting. But there's oh gosh, I have a great client of mine who came to me. It was the first time they'd come to me, and every other bank had said no to them. Every other lender, every other bank, no, no, no. We have to sit down and really work the numbers. In a seasoned investor, there are a lot of moving parts. A lot of moving parts. And if you don't want to sit down and go through and dissect each individual property to find the maximum amount available to use as income or cover their expenses, if somebody's not willing to do that, it is going to be a no, 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 and a no. So really sitting down and going through that closely and finding every single dollar we can to allocate from the properties. And that's normally, when you say getting creative, that's the creative piece, is that honest, straightforward relationship that I have with my clients, so I can truly understand their portfolio. When it comes to investing, almost every single one of them, we have to get creative, and creative being a very loose term. We're not breaking any laws and we're not hiding any money, because everything is looked at closely, to the point to where we have to prove where down payment money comes from. Sometimes if they just all of a sudden, oh, here we go, $50,000, well, they're going to want to know where that $50,000 came from. So it's all creative. I could give you 1 million scenarios, but they're all very similar. It is just simply sitting down and truly looking at every corner we can in your portfolio, so that we can find every dollar we can and then get that right loan for you. And sometimes it's also me on the phone all day, calling every rep I have at every bank and pitching the client to them. Sometimes that's what has to happen. And I've done that too. I did it for 3 weeks straight with one client, every day calling. I narrowed it down to 5 different lenders and called them every week for 3 weeks. And I finally, after the 3rd week, the guy said, okay, send it in, let me present it. And they got the loan. And so
That's awesome.
that's just, we really have to dissect it.
I think that that's like such an important piece for people who want to be investors, is that it's going to be easy sometimes. Like, oh, it's going to be so fun. We're going to own this property and then we're going to like make it cute and rent it out. But there's so many moving pieces, and it's so important to have your team in place to build this team, and of people you like and that you trust, because it's going to be this mutual, relationship of working together. So thank you so much, Lynette. I don't know if Jaclyn, if you had anything more to add or any extra questions in the chat.
I have something to ask. Oh, go ahead.
No, you go ahead.
Oh, I have something to ask for Lynette. So Erin was talking about, when you go to the CPA and you need to let them know what you want to do, so that they can guide you based on deductions and things like that because of your tax return. I have a lot of people that I work with that are servers, bartenders in the hospitality industry. And I have said it many times, but I feel like it would mean more coming from you as the loan officer. Could you please make it so that they can understand how important it is that if you want to buy a house, if you want to do all these things, you have to claim all of your tips. And I'm saying this I was a restaurant manager. I was in restaurants for over 30 years. And I'm saying this because people that I work with, they just don't want to do it. They want the house, but they don't want to claim all the tips, so it doesn't show the income. So could you touch on that a little bit so that when I send this video to them, they'll hear it from you and not just me?
You only have to claim your tips for like a year. Just be hot and heavy on the tip declaring for a year. you're absolutely right, Karen. I served and bartended for years, and I know, oh, cash was king. That was great. But when it came time to get funding, so simple math, as quickly as we can do this, when you are purchasing a home, you have your income, whatever's declared, whatever you're declaring, whatever you're saying, whatever on your tax return and your W-2s, you have your income. And then we take that against your debt. And there's percentages. You can't get financing if your income is $2,000 a month and your debt is $1,500. That's a 75% debt to income ratio. And no bank wants to lend on that. So maybe you really, off of those numbers, which I hope nobody's making only 2,000, but maybe you have an additional $1,000 a month that you're not claiming on tips. So really your income is $3,000 a month. That debt is still $1,500. You just created your debt to income to be 50%. We can get financing for 50%. So you not declaring that income skews your debt to income and makes it not only more difficult to get a loan, but your interest rate is going to be higher. And when your interest rate is higher, your payment is higher, which also makes that debt to income higher because we have to calculate that in that ratio. So it's so important. And we just need it for a year. So for a year, you take the hit, you pay the taxes on it, and you own a home. You are now ahead of the game.
Absolutely. Thank you for breaking that down, because I hear a lot, I pay $2,000 a month in rent, but the bank says that I can't afford a house and my mortgage would only be $1,500 or whatever it is. Well, yeah, that's because the bank doesn't see all the money that you make because you don't claim it. So I'm glad that you touched on that. And I hope that some of our people that are in the hospitality industry, I think all of us actually, Erin, myself, and Jaclyn, we all come back from a hospitality industry background at some point in our lives. And I also think that's why we are so passionate about helping people, because when you're in hospitality, that's what you do. And so I'm really glad that you broke that down for us. Thank you.
Yes, absolutely.
And just to add to that too, even for those of us that are 1099, like, real estate agents, if Lynette, you could touch on that a little bit. I mean, for my CPA over the years, I mean, she's fantastic and would claim literally everything. And it looked like I made nothing at the end of the year. And I would tell her, I'm like, you don't have to write off my car. You don't have to please just leave some of it on there so it looks like I make some money, so that I have some borrowing power. How does that look when the individual is 1099? Do you look at the income, and then how does it look do you look more closely at the income or the bottom line?
It's all in the taxes, and it is. So another team member, your CPA, you have to have this conversation with them. They can put different write-offs on different line items that if they change the line item, it doesn't change your tax, but it changes your buying power based off of what line item you put the write-off on. And they should know exactly where to drop that in and what to do to make sure that you have more buying power. It's not the end result we always look at. It's a little bit further up that totem pole that we're looking at to get that income amount. It's not necessarily the bottom net that you have.
Awesome. Yep. I had to play around with mine a few times, and then was able to have great borrowing power that I didn't previously have. And it was just a matter of moving those numbers around. And I was quite surprised when that happened and how that changed my borrowing power. And I did much like what Erin did, was I purchased a primary with a conventional loan with only, I think 5% down. We used that as our primary. And then we bought another primary home and held that and turned it into a rental property. So now I have a couple of rental properties or long-term rentals, because that's what I did, is I I held onto them, much like Erin did, and then bought another primary, moved into there, and was able to use a primary conventional loan with, again, a small amount down, 5% or whatever we ended up doing, and turned that one into a rental property. So that worked really well for us. I think that's a great way to invest, because you get all the benefits of the primary loan, and you get to keep your rental property. And over time, they've really done well. So we did have one question about the fix and flip, which you touched on a little bit. If Lynette, if you could touch on that, and to any of you who have had experience with the fix and flip, if you want to touch on it as well. But what kind of financing options are available for that?
So the fix and flip financing is more of a shorter term financing. It's not necessarily the conventional loans. We're going to the lenders, and they're giving you a shorter time period. They want to see the loan paid off or transitioned into a normal conventional loan within 12 months. Normally it's 12 months. They want to see everything done and refinanced or sold and moved on within a 12-month period. And
Lynette, I'm sorry to interrupt, do you work with hard money lenders, or is that a different type of product?
both. It's both.
Okay.
We do actually, Brian, that I work with in the Tewes Mortgage office, he has a lot of great connections with some hard money lenders that I've been witnessing myself. And then I have a portfolio of lenders that I go with too. And we're seeing more and more lenders coming to the table and understanding that this is a viable and active need for financing. There are a lot of people that are going and purchasing distressed properties and putting the funds into them. And so they not only are needing the funds to purchase the property, but they need capital to fix the property up, so that then they can flip the property and put it back on the market. And so maybe you're purchasing a property for $400,000, but you need to put $200,000. You're really looking for $600,000 worth of financing. And so we look at what the end result is anticipated to be, the current result. We sometimes, depending on the extent of it, we need the budget, the plans. If you have a builder involved that's doing any sort of renovations, they might want them involved. So it's out there. Yes, it's available.
And from the newbie investor that's maybe interested in something like this, the short-term loan, that would generally be a higher interest rate, right? Because it's riskier.
It is. And when you say the newbie investor, for a newbie investor to come in and want to do any sort of maybe new construction build, renovation, remodel, one of the first questions they ask is, do they have any history in this? Have they ever done this before? Sure. Again, if you're extremely green in the investment and you've never remodeled a home, you've never built a home, whether you could have done it on your primary, and that's experience. Yeah. But if you don't have any of that experience and you're coming saying, oh, I can do this, I know I can, I watch HGTV, they might shy away from that.
Put some time in.
Yes.
Gotcha. And then, but the goal, so for an investor that is interested in a product like that, like you mentioned, for some of us, if you want to hold the acquisition instead of flip, then you can refinance that into a conventional option, and you can pull out, right? Hopefully you put in the amount of work and the equity has built, and then you can pull all that out, essentially pay off your lender, and maybe even walk away with some cash.
Very, very possible. Yes, absolutely. And that's one of the conversations we need to have too, because every time you refinance or you finance or you shuffle money, that costs money. So we have to take a look at the whole picture and make sure that you see all of the numbers, where maybe something up front might be cost you a little bit more, but at the end result, it's better than 2 or 3 different refinances down the road, or maybe
Right.
doing something and it doesn't matter, just get it in, pay the interest rate. You're only paying the high interest rate for 6 months. It'll be worth it, because when you refinance, yes, we're going to pay some extra fees, but now you are ahead of the game by 5% more than you were if you would have just held on here. But this gets you in the door. So we're going to talk about all of those steps and how that's going to pencil out all the way down. So we're not just looking at today. It's we are looking at the projection.
And when you say fees, you're insinuating like closing costs and points and all that kind of stuff.
Oh,
Yeah.
yes, closing costs and all of that. Yes, yes.
Awesome.
Good
And
info.
there's new products all the time too. We're seeing now a lot where new construction, there's a new construction to perm loan now. So they're offering financing where previously you had to get the construction loan, then you had to get a conventional loan at the end. Now they're realizing a lot of people are doing it. So let's just find the program. They're developing the program for the all-in-one, and then you're not doing that. So there's always new products on the market.
Gotcha.
That's great. That'd be really nice if that gets worked out, where it can just kind of transition over to a conventional or something once the construction is done. That'd be really neat.
Yes.
And really, and for the fix and flip, seller financing sometimes can be a really great option. There's different requirements. The insurance requirement may not even be there for the fix and flip. So depending for the seller financing, depending on the condition of the property. I was looking at an investment property about a year ago, which we didn't end up moving forward with, but he was offering seller financing, and that was what made it interesting for me, because it needed windows, it needed a roof, it needed a lot of the bones of the property. And so, that was going to be a lot of cash out to do that. And the insurance was going to be really high until those were done. So I was trying to negotiate with him that we would do a short-term seller financing between 1 and 3 years. We're going to immediately put windows and we're going to put a roof. And I don't want to carry insurance during this phase, because it was going to be like $12,000 a year for the insurance until these were done. So, sometimes that can be an option. I mean, that is high risk, but I was personally okay with that. I'm not advising that for anybody else, and it depends on the house. And we can do work. My partner and I are very handy, more him than me, but he could do all of the work. So we were calculating, if a storm were to come and there's going to be some damage, are we going to spend $12,000 that we would have spent on insurance doing the repair because we can do it ourselves? Probably not, honestly, depending on the storm. But so we were weighing out all those options, and the best option would have been seller financing for 1 to 3 years, not carrying insurance while we do this work. And then we would get conventional financing at that time, which would pay off the seller financing loan. We'd have a balloon note. We'd go see our regular mortgage lender and get a regular conventional loan. And be able to pay that off and get insurance and all of that at that time once the work was done. So sometimes for the fix and flip, hard money for short term might be one of the only options or the best option, or a seller financing situation. So talk to your agent about that, and you can certainly have them write those offers if the seller doesn't have a mortgage or has a small mortgage. Those can work. So
I was just going to say, so like you're not only, catering your loan programs to the person and like my individual debt, it's also, for the house, like
Exactly.
What makes best sense for that investment property, like what Jaclyn was saying. So that's why you need a professional.
That's right. Start with a good agent and you're going to get to the closing table. So wonderful. Does anybody have any questions or anything else they'd like to share? Panel members or attendees, anything that you'd want to ask or share? Now is a good time, because we are nearing 5. It is 5:11. So we are at the end here.
No, I think this was a great for the intro investor and somebody that has invested, that that maybe thinks they know everything about investing.
Well, and like Lizette was
yeah.
saying, I mean, there's a constantly new loan program. So even to the seasoned investor, they may have learned a little bit about some newer products that are available. The DSCR is becoming more and more popular from what I'm seeing, and some other options that might be available. So
Yeah, and it's accessible for all. So I'm glad we made that point. Like, people shouldn't think that because they don't have the money necessarily that they can't start. And all of us have, we all have investment properties. We all have different backgrounds, but we got to the point of having them. So
gotta
we can
start
do
somewhere.
it. We can do
You gotta,
it. Yeah.
yeah, gotta start somewhere. And we've talked about this. We talk about this all the time with our clients, that if, to go from renting to buying, oh my gosh, you're gonna see such a difference in your annual bottom line. You get to write off your mortgage depreciation, your mortgage interest, and all of that. But oftentimes, first, last, and security, instead of paying that, that can go towards a down payment, and you're halfway there. So you can even ask for seller concessions to help pay for closing costs on a lot of these loans. So it's really not always as unattainable as a lot of people think. It might start with claiming all of your tips, like Erin brought up. So you might have more borrowing power than you think, but it's setting yourself up for long-term success. And start with talking to a good real estate agent and a good loan officer, and you'll get there. So, all right. Well, thank you all so much. And thank you again to the panelists today. Lynette Remund with Tewes Mortgage. Thank you so much. You're a wonderful guest speaker. We'd love to have you back sometime. Thank you, Karen. Thank you, Karen Williams-deCastro and Erin Kiel from Better Homes and Gardens Real Estate Destinations, and to our committee members that helped put this together: Jana Pratt, Ada Rodriguez, Samantha Arce, and Stephanie Camacho. Thank you all so much. And we'll look forward to seeing you all again on February 21st to learn all about the home inspection. That one's really fun. And the title phase. And then again on March 6th to learn about insurance. So I know you'll all have a lot of questions there. So tune in next time. And thank you all so much. Signing off, Jaclyn Kelley from Better Homes and Gardens. Thank you all. Bye.